Good evening, everybody, and welcome to the next edition of On the Move. I'm Rich Checkan, President of Asset Strategies, and hopefully you know me by now, and hopefully you know this gentleman as well, Adrian Day, fantastic long-term friend, fantastic money manager, fantastic knowledgeable person on anything, finance, economies, et cetera. Great person to have in my life for the past, 2, 3 decades. And Adrian, as always, I love the chances we have to get together and discuss real topics. And I'll pass it on to you and introduce our fantastic guest this evening.
Okay, well, thank you very much, Rich. I'll introduce the co-host and the founder of this series of webinars, Rich Checkan, who's the president and COO of Asset Strategies International, primarily a coin dealer. They also, a distributor for the Perth Mint and so on. I'm not going to be as effusive as you are, Rich. Not that I don't reciprocate the sentiment, but my English nature is not effusive, so I'll leave it there. But you know that it's reciprocated.
No offense taken.
It's our great pleasure tonight to introduce our guest, Dr. Mark Thornton, a senior fellow at the Mises Institute. He was the Peterson Luddy Chair of Austrian Economics from 21 to 23. He currently hosts 2 podcasts, and you can get on the list for those. He serves as a book review editor of the Quarterly Journal of Austrian Economics. He's written, edited several publications. I'm not going to read them all out, but we may get into 1 or 2 of them later on. He's also served, Dr. Thornton served as a member of the graduate faculties at Auburn University. Auburn, incidentally, is where the Mises Institute is located, as well as Columbus State University. And he's taught economics at Auburn University, as well as other universities in Texas, Montgomery and Trinity. So with that, welcome, Dr. Thornton, or Mark, as you said I could call you. And let's just get right into it, if I may, with a very, very broad and very, very general question. And that is, how do you see the state of the US and global economy right now? And what do you see as some of the major risks in the economy or to the economy?
Well, this doesn't deviate too much from other people, but I see the American economy and the world economy as very weak. And in the US, we have almost 60% of households that are in a recessionary condition where their real incomes are falling. I also see the American economy as very unstable. We've had submarket interest rates now for about 17 years, which is one of the longest periods in history, with a few small periods of above market interest rates, like in 2022. Stocks and the stock indexes have been in very long periods of economic boom, and they are historically overvalued, really the highest valuations in history. And of course, the main problem that works its way into both the weakness and the instability is all the debt in the economy. Governments, obviously, it's not just the US, it's governments around the world. They're running unprecedented deficits. National debts are hitting historical high levels all the time. Businesses are also highly indebted, and they don't know it yet, but they're investing in a lot of male investments, from what we call in the Austrian school male investments, because of those submarket interest rates. And then, of course, households are very highly indebted. And as we can see in credit card balances, credit card defaults, people not paying their credit cards, and all 3 categories of debt, because debt can be a very good thing too, But in all three of those categories, the debt is largely non-productive. The government is borrowing for consumption purposes, and households are borrowing for consumption purposes, and corporations are largely borrowing for this, artificial intelligence and advanced technologies, which could be very problematic moving forward. So that's where I see it.
And what about inflation specifically?
Well, I think inflation and as a result, interest rates, that we've really turned the corner from a very long period of declining interest rates since 1980. Interest rates have been slowly declining, and the reported inflation rates have also been largely declining up until the last couple of years. And now we've been experiencing, since the COVID event, higher price inflation in the economy, higher CPI, which underreports that price inflation, but it's nevertheless the official measure. And interest rates have also gone up, and they're both going up together because, of course, interest rates include a inflation premium in them. So as inflation goes up and higher, then the interest rates are going to go up, and that's problematic both for all current debts as well as all future investments. So it's going to undercut previous debt and previous investments, and it's going to prevent a lot of future investments, productive investments in the economy. And the Fed has been, since the 22 low, the Fed has been increasing the money supply at a very high rate ever since then. So there's nothing to lead us to believe that inflation is somehow going to miraculously turn around at this point.
Yeah, so Mark, I've heard a lot of people talk about the comparisons between what's going on right now and what happened in the 70s. And I see a lot of those parallels. I'm wondering your thoughts on that. But I see one very big difference from now to what happened in the 70s, and that's $39 trillion in debt. And that makes a big difference when you need to fund, those payments on the debt, and you have to fund further debt. It just keeps spiraling out of control. I see that as the biggest difference, and it's not a good one.
I think you're spot on, Rich. In the 1970s, I was fairly young then, but I was also very well aware of what was going on in the economy. And I think one of the first things I realized in my life about the economy that we had gone off the gold standard. And that was a very dramatic event in U.S. Economic history because it took away the anchor of the entire economy. Everybody could count on knowing what the dollar was worth in terms of gold going back 200 or more years. And then after Nixon took us off the gold standard in August 15th, 1971, we no longer had that anchor. And so expectations and all sorts of things went haywire. And of course, the Fed didn't know what to do. And as a consequence, there was a long period of uncertainty and misadjustments. And the financial sector eventually grew as a result to compensate for all this uncertainty and the lack of an anchor. And the financial sector of the economy had to more than double in size relative to GDP in a very short period of time. So you had more people and more analysts and more hedging and more, all sorts of hedging in the marketplace by companies and, the whole nine yards. So that was different. Today, of course, we're facing approaching $40 trillion in national debt. And that's not just a national problem, that's an international problem. We have Japan and Britain and France and other countries with unsustainable debt levels, and you have the debt, you have the added national annual deficit, and then you have the interest that the countries have to pay on all of that debt. And that's become the single biggest concern in the economy and in the stock markets with interest rates and the bond markets, cyclical factors and so on. The United States is approaching $2 trillion in deficit this year, and they're having to roll over, I think it's $9 trillion of debt. So that's just become a huge concern that previous presidents and previous administrations and Congresses didn't really have to consider. And that, I guess that's part of the problem, is nobody considered, what was the long run problem with all of this debt. But it's coming due, it's crimping everybody's style, and it's crimping everything that there is really in the economy. And that's another, of course, primary reason why I forecast that, interest rates will in the long run head higher.
Well, that really, it raises a question. It's a massive amount of debt compared with 1970s. It really raises a question whether another Paul Volcker could actually take interest rates to 20% of a short end. I mean, you could do it in 1980 and cause a recession, but to do that today would just destroy the economy, it seems to me.
I think you're right, Adrian. And, the idea that they could massively increase the interest rates and wring out demand, consumer demand, the demand for automobiles and homes and all the rest, and business investment and, and all of that right now. And, the impact of those higher interest rates on the financing cost in the public sector for sure, but even in the private sector would just be devastating. And so they no longer really have a clear path to clearing out the inflation. Of course, just stopping the money supply growth would do the trick, but in order to do that, you would have to significantly raise interest rates. Right. And that's just not a card that they can play today. They have to more or less play with our expectations and keep our expectations regarding inflation and interest rates subdued somewhat. And that's the best they can hope for in a realistic way.
I get your thoughts here? I mean, I hear a lot of people calling for it's time. The debt is so far gone, and we haven't even talked about unfunded liabilities at this point. We're just talking about, the balance sheet year to year. It's so far gone at this point that people are calling for another reset. We've had several resets going back through time. Do you think that that's the answer, or do you think, from an optimistic standpoint, that it's not too far gone? That if we get the right mix of reduced regulation and decreased taxes and underspending, believe it or not, if that's a word that we can use in 2026, if we get the right combination, that we could still actually grow our way out of this thing?
Well, I suppose if there was a button right here that I was allowed to press, yeah, I'd probably press it and default on the national debt, but that would, of course, cause worldwide economic chaos in the short run. And so the only avenue open to political actors, especially, they're not academics, they're not priests and moralizers, they're politicians. Yeah. And their way out of this is to try to cause financial suppression on the population by keeping rates low relative, and so they're going to force interest rates to remain low by increasing the money supply and buying up excess long bonds and short bonds. It's called yield curve control
Yeah.
as part of financial suppression. Price inflation will move forward. That'll devalue the dollar and devalue the national debt because, the Fed and the Treasury have this big advantage of being able to borrow at the lowest possible interest rates. But with the help of inflation or the devaluing of the dollar, they can pay back the whole chunk of national debt with devalued dollars. And so that's the hand that they have. That's the power that the Fed provides. And I firmly believe that that's the path that they're going to take, where they're going to try to reduce the real value of the national debt, hopefully controlling spending, hopefully controlling new borrowing, but also buying up buying up government bonds by the Fed in suppressing interest rates and allowing the devaluation of the dollar to eat away at the real value of that huge number, which is the national debt.
And of course, the more they do that, though, the problem is that makes the US Treasury market less attractive to foreign investors. And we've already seen that over the last few years with several countries just turning away from the US Treasury market in various degrees. So if you go down that path to try to solve the debt issue, but at the same time you have fewer foreign buyers, who's going to be buying all those? Is it just the Fed's going to be buying all the debt?
I think so, and they may try to manipulate regulatory policy so that banks have to buy more U.S. government bonds as part of their capital. And
How did
part
that
of
work
their
out for Silicon Valley?
Yeah, well, yeah, I don't know. They make promises. Or they just make them. They require them to hold. What do they call them? High quality assets. By rigging the value of U.S. government bonds, U.S. government long bonds, as part of their asset base,
Yeah, they don't have to
and
mark them to market. Yeah.
and their reserves. They can. Well, that's how the South Sea bubble and the under John Law, he kept on rigging the system so as to create new and unforeseen advantages to people who were holding stock in the company. The prices of the stock went up, and they were able to issue new shares, and everything seemed to work there for a while. But and of course, the government and the Treasury and the Fed do have that draconian control over banks, and they could use that. So they might force banks to hold more of their bonds. But you're right. In the old days, foreign central banks held massive amounts of U.S. government bonds as part of their reserves,
Yeah.
and a lot of our domestic partners, like Japan and Korea, even China for a long time, bought a huge amount of those U.S. government bonds. But even other central banks don't trust the U.S. dollar anymore, and so they've left and stopped adding to their holdings of U.S. government bonds. They've reduced those holdings, and they've greatly increased their holdings of gold as part of their reserves. So, and some of them are pushing for a more gold backing of international trading currencies. So even the central banks don't trust other central banks, namely the U.S. central bank, the Federal Reserve.
Right. You know, you mentioned John Law. There was a fabulous biography of him that came out about 5, 6 years ago. Did you read it? I forget the name of the author now.
Was it Antoine Murphy?
No, no, it was a very popular book. It wasn't, but when I read the book, it was a fabulous biography. I'll try to get it for our recap, Rich.
Okay.
I tell you, not as I was reading through this, it reminded me of nothing except Alan Greenspan and the Fed. Yeah, I'll try to get the name for you. Talking about the Fed, sorry, Rich, did you have a?
No, I think I want to go on to something, but I think we're on the Fed, so let's stick there. But I think you were touching on when you talked about the reallocation of the currency reserves with the central banks. I think you started touching on what potentially your best protection is in this environment. But before we get there, I'll let Adrian go to where I think we
Well,
all need to
I
go.
was just wondering, we're talking about the Fed, we've got a new Fed chairman. I don't know if you think the particular chairman we have makes much of a difference, but I don't know if you have any impressions of Kevin Walsh, the new Fed chair, who of course held his first press conference today as Fed chair.
Well, I think he's a very capable individual, and he does think for himself. He's not a creature of the Fed, even though he's previously served on the Fed, and he's from the private sector. But I do believe that we have to read his appointment, which was a big surprise. Remember, he was the most hawkish of the four possible nominees, and he was nominated literally hours before the market crash in gold and silver. And that was obviously an intended effect to switch directions by President Trump. The big banks obviously knew the choice before the markets did. They probably took advantage of that. And gold and silver were pummeled. And, I think it's clear that, that's why the decision was made, although Kevin Warsh's family has known Trump and his family for quite some time, so they were friends, that it was an important connection. And then, subsequent developments indicate like the war can be partially explained, the timing of the war can be partially explained as another slapdown on precious metals. And then even today's press conference with the things he said he was going to do and the things he said he was going to be concerned about, and the fact that he only talked about reducing price inflation and he didn't even mention labor market stability is a clear slapdown to the precious metals. And also, simultaneously, this is all meant to support the price of U.S. government bonds, to keep those rates down by threatening deflation, lower inflation, higher interest rates. We haven't seen any of that, but because of all the talk, because of the appointment and so forth, and the war, and now the press conference, and then the peace initiative right before the press conference, and so on, before the meeting, I should say, and press conference, they haven't actually done anything, but they've sent very, very powerful signals to the market that says, you better not get out of bonds because we're going to threaten to, lower those bond prices. And, we're going to defend the value of the dollar, and we're going to fight price inflation. They might do that. That does happen occasionally. But in the situation that they find themselves in, they don't really have a lot of opportunity, as we just discussed, to really do the job of fighting price inflation and stabilizing the economy with normal interest rates.
Yeah, I tend to agree. I don't think they can do it without Congress's help. Period. I mean, they can try to lower inflation by raising interest rates, I guess. But in the end, as long as the Fed or as long as Congress continues to overspend by 1.5, 2 trillion every single year, I think the Fed is powerless. Yet today in the press conference afterward, Warsh, I want to say it was like 7, 8 times. He said that we have failed for the past 5 years to get down to that 2%, but we will do it. I never heard how he was going to do it, but he was pretty adamant that they were going to do it. I don't know that he's capable.
Well, Rich, you're absolutely right. Congress, if they balance the budget, let's say, without raising taxes, that would completely free the Fed up.
Yeah.
They wouldn't have to raise interest rates very much to totally squash price inflation and bring the yield on bonds down and stabilize the prices. And of course, I'm particularly concerned about the long-term interest rates, the 30-year and the 10-year. The 10-year government bond interest rates is really at a breaking point, and the 30-year rate is really at a crisis level that if either one of them go much higher, that signals severe trouble and a possible crisis developing that may spiral out of control. Whereas if Congress balanced the budget, the pressure would be off the Fed. They wouldn't have to do much to get the job done.
Yeah.
And then they could start rolling off some of the existing debt slowly over time. But this is a rational, business-like approach to things. And that's not what we're seeing in Congress. We don't see any effort. We don't even see them talking about balancing the budget or cutting any kind of spending. They don't want to cut anything.
Well,
And I
if
think,
you do, you get opposed by someone else and lose your election.
yes, yeah, it's definitely a catch-22 in today's political and ideological environment. And it's also an environment where, the political elites really control our political process. It's not actual voters and, small donors and that kind of thing. And so the big money that comes into these races, protecting the interest groups and the spending that goes into their pocket is really devastating on the political trail. And also political competition is headed off at all passes. They don't let minor parties on the ballot. The congressman from Kentucky got run out by interest groups, and it's a different type of combat out there where the local voter has almost no say in the outcomes of the political process.
Hmm.
Rich, you were going to switch the subject, I think.
Yeah, so we talked about the economy, we talked about the inflation. Obviously, we have a bad situation at our hands, but I'm a believer. I think Adrian is. It sounds like you might be as well. What are some of the things that people can do in this environment to protect themselves? They've worked hard, they've set some money aside. Maybe right now their wages are not keeping up, with consumer price increases and whatever's coming down the pike because we see PPI is popping up as well. But there are some steps they can do. What are some of them that come to mind,
Well, I'm
especially from an
always
Austrian school perspective?
Yeah, I'm always, believe that you want to get rid of all of your debt that isn't in your home mortgage, which is tax advantaged. Higher debt rates makes you more susceptible to personal crises. You should have some savings in cash, but you should also, I've been a big believer in precious metals. Even before they took us off the gold standard, I was a coin collector, and my relatives always took the silver coins out of the register of their businesses. And I just felt like they were really smart and everybody else was really dumb. And I just knew that instinctively somehow. And so that's why I became enamored as a little boy, really, with coin collecting and also, as an investor, I've always preferred all things the same. I would prefer real assets. So right now, I think it's important to be invested in gold, invested in silver, invested in gold stocks and silver stocks, and also I'm also, my forecast is for a long-term relative gain in all of the commodities. So not just gold and silver, but oil. And I was, buying oil stocks. I've held them a lot in my life, but I was investing in it right before all this mess with the war, when it was like $57 a barrel. So I'm a big believer in the commodities, especially right now. I think we're in for a secular advantage in commodities. And so that's where I'm pointed. And I also, to a lesser extent, I like the emerging market investments in those countries to a limited degree, because they tend to be, first of all, they tend to be commodity-based countries, and also they have had a problem in the past with dollar-denominated debt. But if the value of the dollar is falling, that should further advantage those economies and those companies in those economies that export real things to the rest of the world. And so that's my general feel, is that I think bonds are in for a very, and I'm also a long-term oriented investor. Well, I guess all investors should be long-term.
Should be, yeah.
So my longer term perspective is against bonds in general, against fiat currencies in general. I'm very high on precious metals and precious metal mining and mining related stocks, and then the whole commodity complex, including other metals, strategic metals, food products, grains, and all the companies that support those industries or those products out there. So that's my general outlook of trying to turn what I know about Austrian economics and the state of the current economy and policy. And of course, we're facing, just widespread socialist ideology too. So,
Definitely want to
given
get into
all
that
that,
here in a second, for sure.
yeah, that's where I'm going.
No,
Yeah. If I could, Adrian, just real quick follow up to that, because I hear from a lot of folks that with gold at all-time highs, it's too expensive to buy, right? So, of course, I heard that, mind you, at $1,800. I heard it at $2,400. I heard it at $3,000. I heard it at $5,500. And so far, that's the high water mark. But I think it tells me two things, and I just want to know your thoughts on this. One, people are looking at gold the wrong way, right? So to me, it's always been wealth insurance. It's been a store of value. It is not a get rich quick scheme. It's not an asset that you look to appreciate. The only reason it's appreciating is because what we measure it in is depreciating so rapidly. And that's the second point, is that as we measure things in dollars, whether it be copper, or coffee beans, or gold, or college education, this distorted view of value that you get with an ever weakening dollar just makes price discovery almost impossible. Do you agree with
Yeah,
me?
I agree wholeheartedly. I would say, with particular respect to physical gold ownership, that myself and I think a lot of people that I respect We really don't have any intention of ever selling it. I think of it as a long-term wealth stabilizing asset that I plan on passing down to uh, my relatives and the Mises Institute. I mean, actually, the Mises Institute is the best investment you'll ever make with your money. But and then of course silver. Well, I might not keep that forever, and I might turn a lot of the other assets as I go to retirement and so on. And I might make them less speculative and more revenue generating and that kind of thing. But with physical gold, I really don't have any intentions to use it. I can see using it, in emergency. That's what it's there for. I could see using it to pay down debts or, do a variety of different things. But my general purpose is just to hold it. And, gold is what Western civilization and capitalism developed on as a monetary institution. Government took that away from us, and I think that we can reestablish some of the stability and continuity and the better things in life for the people around us, at least, by kind of investing in your own personal gold standard. So, yeah, I mean, all of my investments sort of hearken in the same general direction, but that core asset is, in my mind, very different.
No, absolutely. And
Thank
I
you.
think your initial advice, to pay down debt other than, a home mortgage, but to pay down debt and always have a cash reserve, that is so critical because so many people think that they can get better returns by leveraging themselves and everything. And, that works as long as it works. But the beauty of reducing debt other than the house and having cash reserves, there's two beauties. One is it, there will be crises in life occasionally. Hopefully not too many, but there will be crises. And if you've got that cash reserve, you don't have to make stupid decisions when the crisis comes along. Because I know from managing money for 40 years, when people call me and say they need a 10,000, 20,000, I once had someone want $2,000 out of a managed account today. I need it today. It never comes at the right time, right? It always comes when the things they own are unstable. So if you have that cash reserve, you don't have to make bad investment decisions. And the other thing, of course, is that it just enables you to sleep at night, which, we shouldn't gainsay that. That's very important.
I agree wholeheartedly. When, you know, holding gold can be lead to anxiety if you have debt and you don't have any cash. If you paid off most of your debts and you've got plenty of cash and plenty of income for the foreseeable future, then you don't really care what goes on in gold. You're not even following it on a day-to-day basis. So I really agree with that sentiment. And I also am a big proponent of buying relatively small amounts on a regular ongoing basis so that, you're adding to your holdings um, in a good way, and you're dollar cost averaging. So if the price is falling, you're getting more. If the price is rising, you're getting less. And then, after once that runs into a period of many years, you're just not really concerned about it. You don't even know what your cost basis is. And things just go a lot more smoothly. And, today's politicized world, anxiety and angst is just run amok in American society, but it's also, in Japan, China, India, the Middle East, Europe. there's just an ongoing anxiety caused by this sort of all-encompassing government involvement in our lives. And man, I mean, gold ownership is a great anecdote to that. Um, uh, and I think even more so with stock markets, it's such highly leveraged and overvalued levels that people are really concerned. And I hear people discussing this about should I get into SpaceX, and aren't these AI companies just trying to offload their debt and their shares at the high point in the market? Aren't they just trying to put more of these shares into retirement accounts while they're taking cash out and maybe buying gold? So I don't know the answers to those questions, but it just points to this incredibly high level of economic anxiety and political anxiety, really.
Rich, can I jump in there unless you had
Yeah,
something?
no, absolutely.
Okay, so Mark, when you were talking about how your portfolio is positioned with gold, commodities, emerging markets, no bonds, and an overvalued U.S. market, it occurred to me, and you acknowledged it in a quick comment, but it occurred to me that everything you own is, although it's somewhat diversified, it's all pointing in the same direction, right? A weaker dollar, and indeed higher inflation, because higher inflation, emerging markets tend to do well in a period of higher inflation as well. Excuse me. And so I'm a long question, if I may, or a two-part question, and that is, to what extent does Austrian economics actually inform your investment analysis? And then maybe for those of us on the call who don't know, could you maybe just explain a little bit about what Austrian economics is, maybe how it differs from other schools of economics, but without getting too technical, of course, but just tell us briefly what it is.
Well, the Austrian school grew out of its criticisms of classical economics, where they believed in groups in the economy rather than individuals. They believed in the labor theory of value. They didn't have any kind of model of price determination. I mean, they broadly talked about supply and demand, but they didn't have a theoretical model of price determination, which we see every day in the world, but they didn't have any kind of proof, a scientific proof. And so the Austrians made many, many corrections to the old school, and basically brought forward a very realistic view of economic people and how they operated in the economy. And they provided all the criticisms as well to these older schools of economic thought. So they were very highly thought of. The work of Carl Menger spread very quickly to students like Eugen von Bavarick, who was the finance minister of Austria, and then to Ludwig von Mises, and then his student F.A. Hayek, who won the Nobel Prize, and then into the United States. But it's very realistic compared to mainstream economics, which is mathematical and statistical, where they develop models with unrealistic assumptions, unrealistic models, and their only criteria is if the models predict correctly. But it's not that the models predict the future correctly, it's if the models predict other subsets of the data correctly. So it really doesn't strike me as realistic or effective because, of course, they're not very good at making predictions about the future, and we all know that. So it's, there's lots of problems. Of course, Milton Friedman was a libertarian and free market oriented. And of course, nowadays, since Mises was proven right about socialism, they're all nominally for the market and price determination in the market, but they're also really left-leaning socialists who always want to intervene in the market because the various markets don't stand up to their models of perfect market functioning. And that they're also not concerned with market evolution to new products, new technologies, new consumers, and all the rest. So we really have what normal people, business people, entrepreneurs think is the proper approach to understanding the economy based on logic and deductive reasoning for not a robot of Homo economicus, but of everyday, ordinary people with their own views, their own choices, and their own faults, their own ignorance. That's how we build our models of the overall economy. And so, I think there's a huge difference, and that difference has actually grown enormously over my career. When I started, in economics as a college student, I was a Friedmanite. And, I believed that money caused inflation. And I followed Friedman on all his policy views, not really knowing his methodology was Keynesian and mathematical and statistical, empirical. And then I discovered the Austrian school, and it was very realistic. It was really based on, I think it's really based on the entrepreneur. And so I've been a big follower, and I've seen it grow and succeed. I've seen, as a matter of fact, my last book, the second half of that book, shows where Austrian economists correctly predicted every major economic crisis of the last 100 years. And the mainstream economists, the leading mainstream economists, had no idea what was going on and said that things were looking great and were heading higher. And that's true, in all the major economic crises. So, and as a result of that, the Austrian school has gone from really a dead school of economics when I entered graduate school, a very long time ago, to now it's really a thriving international school. We're still the smallest branch of economics, but we're the fastest growing, and we have the youngest age profile of any school of economics. And so it's doing great. It's becoming more pronounced. And when we look at the private sector and just regular individuals, they call themselves Austrians or followers of the Austrians. So I entered this whole scene when the Austrian school was a complete mess. I just happened to show up in Auburn, Alabama, the year before Lew Rockwell founded the Mises Institute. And people thought he was crazy. But over the last 40 years, he has pulled off what would otherwise be considered a miracle. And everybody was opposed to what Lew was doing, except the economics department at the Auburn University. And I've just been incredibly lucky just to have been at the right place at the right time.
You talked about the Austrian school has predicted the busts that we've had. Can you talk a little bit more about the boom bust theory and where we are right now in that cycle?
Yes, the Austrian business cycle theory starts with the notion that money doesn't enter the economy mysteriously or drop from helicopters into everybody's wallets, but that it enters the economy at a very specific place. namely the Federal Reserve and the market for U.S. government bonds, and that it suppresses market interest rates when it does that below. So the actual rate in the market when they're injecting is going to be below what the market rate would be otherwise. And that rate, of course, creates certain advantages for the first people who get that money, but it induces investment in the economy, and it induces investment in a very particular way by really expanding the economy into new areas and new technologies ahead of its time. So we look at advanced technologies, like in the 1920s, it was things like the radio and the airplane and the refrigerator and stuff like that. In today's world, of course, it's artificial intelligence and some of the other things, SpaceX technologies, but that ultimately those investments, which were artificially induced, tend to be the spot where there's a cluster of entrepreneurial errors and an economic crisis down the road. It explains why all of a sudden there's a bunch of business failures and strategic retrenchments and bankruptcies all at one point in time rather than just spread randomly throughout the economy, which is what we would see in the absence of the Fed. And so that particular theory, which is all based on microeconomics, it's not based on some mysterious thing. And those numbers show up in all of these crises. So every time we have a long period where the Fed is injecting money continuously, suppressing market interest rates, entrepreneurs eventually get carried away. And they get carried away in these advanced technologies which stretch the production processes throughout the economy, and eventually, with fewer people saving money and more people speculating in advanced technology, eventually the whole thing breaks. And I'm afraid that's what we're up against right now. We've had this very long period of mostly below market interest rates, and we're now in a investment orgy with the artificial intelligence companies and the computers and the chips and the data centers. And I think there's probably some artificial policy incentives that have helped that along that are not related to the Fed as well. But nonetheless, I think we're seeing the fruits of this long-term bailout scenario from the great financial crisis.
Yeah, that was the start of it, and then the pandemic response just added to that hyperbolically. So at this time, I just want to add, we still have more things to discuss, but part of the fact that we have attendees at this webinar is because you have some great ideas, and we want to get answers to your questions as well. So if you like to ask a question live here for everybody's benefit, just go down to the Q&A tab and go ahead and type it in, and we're going to get to every one that we can. I hope we can get to them all. I can't promise that. First one we got is from Seth. That's kind of related. He said, "Can you touch on the crack up boom?"
Yeah. Well, yes, that's one of Mises's inventions that term invention that he came up with long ago. His first major work was in monetary theory, in which he first put forth the Austrian business cycle theory, and as part of that was the role of the crack up boom, where if the process of inflation continues, it spins out of control. And as the inflationary orgy sort of proceeds, companies, share prices are going up, and people are moving their money out of banks and out of bonds and putting it in the stock market. and share prices are going up, and eventually that whole inflationary spiral blows up in everybody's face. And you can see that kind of in the hyperinflationary economies like in Venezuela. If you look at their stock market, it looks like it's going gangbusters down there in Venezuela. But it's not because the economy is great or these companies are well run. It's because it's inflation and people are desperate to try to take their money and put it in something real that will keep up with inflation. But inevitably, that race cannot be won. And the economy breaks up into a million pieces as the economy really is speeding towards maybe entering a hyperinflation. So it's a very bad scenario, and it's one that I'm particularly worried about today.
Gotcha. And if I could, I before we finish tonight, I want to get your thoughts on, this rise in socialism, this anti-capitalistic movement. I was encouraged by what you said earlier about the fact that you have a very, very young demographic embracing the Austrian school. I want to hear more about that. I've got one other question kind of related to what we were just touching on. And JJ came in and said, is there a likelihood of AI technology, which is currently moving at incredible speed, expanding productivity far beyond inflation, which would slow or stop the gold bull run?
Well, I think AI is going to be outstanding. It's going to be wonderful. It's already positively affecting certain people. And, even the advanced Google aspects of artificial intelligence are obviously have benefits. That I don't think is the problem. The problem is coming from the Fed and the fact that these are unsustainable investments. And the fact is also that the Fed policy is engendering this high-tech investment before its time, before we've had a chance to grapple with the technological problems, the moral problems, and then the doomsday scenario problems that a lot of people are genuinely worried about. But we never had a chance to grapple with that. And this is something that, in fact, in fiction, people are concerned about, and I understand that. But I think artificial intelligence, first of all, experts have told me that this is not intelligence, and that it's, you can view it as something mighty and miraculous, but you can also view it as, for right now, as just an advanced Google search in terms of finding information quickly and through a different logic and making it available. And of course, there's other aspects, and it's going to unemploy a lot of people. I mean, the government was pushing, thousands and thousands of students into coding, and now artificial intelligence is going to rip that carpet out from under them. But I do believe that it is going to increase productivity, just like Microsoft Word and PowerPoint and Excel greatly improved our productivity. And the computer greatly impact, the personal computer greatly impact our productivity. And the internet greatly impacted our productivity, and email has greatly impacted our productivity. Artificial intelligence is going to be at least as large a step as any one of those technologies. Now, it's not going to offset monetary inflation. It may reduce price inflation a little bit, but monetary inflation is a disturbance in the whole structure of prices in the economy. So you're going to end up with problems that are unforeseeable. Some of the problems Austrians have developed in advance. And we have a good handle on some of the general price disturbances that are caused by central bank inflation. But there are many that have not ever really gone very well investigated. And for example, in terms of wage rates and labor markets, and in terms of, what's this going to do culturally, and what is this going to do to entrepreneurial opportunities, positive and negative. There's just a lot of things that haven't been investigated yet, and we're going to have to struggle through a lot of those.
I tend to agree, and I will tell you that I'm not one of those believers that productivity like AI or any other advancement that has come on in the past. Everybody says, "Oh, that's the end. It's going to put all these people out of work. It's going to
Yeah.
destroy our economy." The reality is quite the opposite. That every new meaningful invention or wave basically increases productivity, puts more people to work as we figure out how best to implement it. So I'm not in that camp. Um, just a comment here from JJ: AI is a race, and if the USA slows down, China will speed ahead and be uncatchable. No one can stop and wait. I tend to agree. There's some truth there. Um, let me see. Any other questions that we haven't answered? Um, if I could, unless you have something, Adrian, I want to get to the socialism, because then I also want to switch back to Seth here, who's asking about some resources at Mises. And I know I want you to share some of those thoughts there as well. But for me, and I don't know about you, Adrian, this is very disturbing. The rise in socialism, it tends to come every time there's division, every time there's unhappiness, every time there's economic, distortion, disarray, what have you. That's where we are right now. And I think there's a lot of people that really don't know what the hell they're talking about, that blame capitalism for what's going on. I mean, even as bad as things may be right now, we live in the best time ever. We all won the lottery to be alive right now, and experience what we have. We take so much for granted that prior generations never even could even think of. And that's all brought about by capitalism. Socialism has never been the answer. So just like to kind of get your thoughts on that. What's bringing this on, and maybe what's encouraging is the young people that are embracing Austrian school.
Yeah, I mean, we thought, when Russia and China, the Soviet Union and communist China fell apart, that, socialism is dead. We don't ever have to worry about that again. And capitalism arose in China and Russia, India. But nowadays, young American adults espouse some socialist positive feelings. It's about a 40% support rate for people in their 20s and 30s. And a lot of that isn't based on their understanding of economics or economic systems. Of course, they're not taught history, really critical history. Many of them have no idea what the Soviet Union is, for example. And, and so they see modern problems, especially revolving around economic inequality. And because high school teachers and college teachers, they're not taught about Austrian economics. They don't know Austrian economics. And, so everybody just responds with simple correlations. America's capitalism, therefore every problem in America is a result of capitalism. They have no way of breaking down. They have no way of understanding cause and effect. Whereas we at the Institute, we teach Austrian economics. We don't expect anybody to, bow and scrape ideologically to the free market or, oppose socialism. What we teach is why free markets work, how they work, and why governments always fail, and how do they always fail. So we give them concrete theoretical information and historical examples so that when a college student is confronted with a problem and saying, well, this is obviously the result of capitalism, they have no way of responding to that. So they break under the pressure, even if they were raised by conservative parents in a business environment, entrepreneurial families, and so forth. They still don't know how it works. And the complex system needs a complex understanding, and that's what we do. Where with students in our programs and adults in our programs too. Not We don't teach them to wave ideological flags. We teach them how and why the market works and why government always fails.
Want to add anything to that, Adrian?
No, not really. I think, one thing you hit on, I mean, it's really interesting, as you say, America's a capitalist society, therefore every problem in America is caused by capitalism. That's a really keen insight. But honestly, I think one of the biggest problems is the wealth inequality, that is caused by government. I don't think, in my experience, I don't think Americans generally are upset at other people having more money than they do. You only have to think of some of the heroes, Steve Jobs and Taylor Swift, or heroine in that case, and football players and so on, who earn massive amounts of money. One of the things that really struck me when I came over to this country, first of all, was the difference in attitude between America and England at that time in the 1970s. When someone was wealthy, whether it was by hard work or just by luck, people congratulated them. If you discovered oil in your backyard, it was good on you. And if you won the lottery, maybe you suddenly discovered relatives you didn't know you had. But people celebrated it, right? They were put on
Yeah.
TV shows. How are you going to spend the money, and so on and so forth. The attitude in England was completely different. You've got no right to that. Why do you have it instead of me? But I think that attitude in America is shifting
For sure.
because of so much what I'll call unfair. And people aren't stupid, even though they don't understand Austrian economics. They sort of get that something is wrong in my view, when so much money is flowing, first of all, to the big money center banks, and people are making these huge amounts of money, huge, multi-billion, multi-million, not even multi-million, but sometimes tens of millions of dollars in bonuses. And people feel, well, that's not really quite fair. That's my sense anyway. But I do think that the wealth disparity is one of the things that's caused a lot of people, a lot of younger people, to go towards socialism because, they just kind of feel helpless. Again, 40 or 50 years ago, there was a sense, or I felt it, maybe I'm being a little romantic, I don't think so. But when I came to America, I got the sense that people, even if they were dirt poor, they felt that with hard work, maybe they wouldn't be wealthy, but their kids could be.
Yeah,
And
the
the,
dream is
the, the
alive.
key word is could be. There was that American dream that people could achieve. And I think now more and more people just feel absolutely hopeless. They don't feel that if they work hard and send their kids to college, they just don't feel that there's a better future ahead for their families.
If I could add
I
to that
agree.
before you respond, Mark, I heard a lot of that coming out of the great financial crisis. So the kids that experienced their parents who did everything right, they bought a home, they worked hard, they saved, they did everything they were supposed to do, and then all of a sudden, in the blink of an eye, they were worth half or less than what they thought they were. And that I think disenfranchised a whole bunch of younger people in this country that said this system is broken. It flat out doesn't work. So I agree with you. That's where I saw it start. What are your thoughts, Mark?
Well, I think, yeah, people don't understand why financiers, bankers deserve their money. They just have no mental relationship with the role of the banker making the
Mm.
decision. I have a great appreciation for that because I know what's going on behind the scenes. But the Austrian business cycle theory actually, it's very interesting because it explains higher price inflation, more money in, higher prices. It also explains the business cycle because there's a disconnect with the interest rate that leads to a lot of investment at certain points and then a lot of investment failures at other points. But it also explains what's become known as the K-shaped economy, where a small subset of the economy, the wealthy, uh, do extremely well, while the majority of people who are in the working class don't do well at all, or maybe are retrenching at certain points in time. This has never been more noticeable than it is today. And that fact links up very well with the idea that we've gone through this long 17-year period of suppressed interest rates and increased asset prices. And it's a very simple question I want everybody to ask themselves. If you're a capitalist, if you've got a lot of assets, physical assets, land, real estate, stocks, bonds, the one thing that jumps all of those up in value is lower interest rates. So if the Fed is using lower interest rates to inject money into the banking system, I mean, they want the more money in there and they want the lower interest rates. But those lower interest rates, yes, they advantage the government bond market. But yes, they advantage Wall Street. Anybody on Wall Street will tell you that. That's what the whole meeting today with the Fed was all about, interest rates and how it's going to affect the stock market. If you ask anybody in real estate, whether they're just selling real estate or whether they're a broker or maybe they're a big investor, they'll tell you that the number one and basically the number two and three things about real estate prices is the interest rate. And if the Fed is putting downward pressure on that interest rate, it's advantaging the wealthy, the asset holders, stockholders, bondholders, and it's allowing the people who can leverage up through the banking system to become wealthier and wealthier. The only thing it does for the working class is higher prices, driving down their real purchasing power of their wages. So all of
If
the
the
evidence,
wages don't keep up, it's a bad scenario. Yeah.
oh yeah, I mean you're going downhill. And it's a very difficult situation. It's really one of the most difficult situations. I'm seeing a lot of people go through it right now, where they're just treading water in their job. They're working full time. They may be working a part-time job. They're working hard and they're earning money, and they can't pay their bills, and they're running up their credit cards, and they're completely frustrated. But I can't do anything personally about that. I wish I could. I try to explain it to many people as possible. But it's a serious problem, and it's so disheartening to the people who are facing this scenario with their families, unable to keep up, even though they're working really hard, and even though they've cut expenditures and they've redone their subscriptions and they've redone maybe where they live or the apartment that they're living in and all these other adjustments, and they still can't keep up. And that's fueling a lot of this socialist sentiment, but it's exactly the type of evidence that we would expect to see from the Austrian school's business cycle theory.
Yeah. So, I'm not a school trained economist. I went to military school. I studied chemistry. I was in the service for a number of years, did some direct sales, and I've been a gold dealer for 30 years now. And that's where I learned what I learned. And what I learned is, I go back to this quote from Zig Ziglar, right? So the best way to get everything you want in life and more is to help more people get everything they want in life and more. And that's the environment I was brought into here with Michael Checkan and Glenn Kirsch here at ASI when I joined them in '96. It's a business they run. They care about taking care of people. So I know capitalism works. I know it makes people's lives better. I've seen it with my own eyes. I am concerned about people that don't get the education. I would argue that you can help these people, and you're doing it with the education that you're putting forth. So that gets back to Seth's question about his nephew's looking for some tools. I don't want to get into Bitcoin, but I ran into a phenomenal young lady early on. We were doing gold versus Bitcoin debates. And one of the things she said is that people were coming for the Lamborghini and they were sticking around for the revolution, right? So basically, they were chasing money in Bitcoin, and what they learned about was Austrian School of Economics, and that kind of was attracting a whole younger crowd. You mentioned that there's a lot of younger people being attracted to your organization and what you espouse. So how can Seth's nephew reach out to you, reach out to the organization, and educate himself? How can others with nephews, nieces, kids, grandkids, educate them so they understand what's going on around them and have a better understanding on how they can succeed in this world?
You go to Mises.org, Mises.org, and just start snooping around. You're going to find something that you're interested in, and our articles cover every conceivable topic, I think. And then we have academic journals, but we have a lot of interest in Bitcoin. Bitcoin was built on a gold standard like model. And so we have a lot in common with the people at Bitcoin. It's a free market money. It was suggested by Mises's student, F.A. Hayek, who won the Nobel Prize. He said, we've got to come up with some way of short-circuiting central banks' inflationary power. And so he's considered, one of the prognosticators about, the future of money. And so we have a lot of different, we have 4 different podcasts trying to reach people at 4 different levels. I have the Minor Issues podcast. It's a 10-minute podcast released on Saturdays about something that the mainstream media is not covering. And we have other podcasts. We have downloadable books. We have conferences around. We have one coming up Saturday, the 27th in New Hampshire on why healthcare has failed us. And we have some leading experts, people with expertise in healthcare and Austrian economics, as well as somebody from the industry. If you're in the area, it would be a great way to meet up with other interesting people and get started learning some solutions and the cause of some of our problems. And so there's a lot of different ways of doing this. Undergraduates should be looking at our Mises University conference, which is great. And, kids come in from all over the world, really bright, interesting kids. We have a graduate student program that goes on in the summer where we have a conference and we have a directed research project here all summer. So, there's just an unlimited number of things that you can connect with. And I just want you to go to the website, start snooping around and see what you find most interesting and relevant to your life.
Can I ask you a question, and it follows on from Seth's, but let me ask you, if you've got a young person who really doesn't know anything about economics or very, very little, what are one or two of the best books you would introduce you would suggest for that person?
Well, Mises has a book called Economic Policy, Six Lessons, and it's a book of lectures that he developed in the early 1960s. And it's about, gold and inflation and but balancing budgets and interventionism, price controls, like things like that. So it's an old-fashioned book, but a Brazilian, one of these cage-fighting Brazilian guys, uh,
UFC.
made it very famous after he won a championship or something. And the book is being read worldwide by young people now. Throughout South America, it's been translated into many different languages. So, I never know what's going to be popular next. It's really hard to tell, but when a celebrity like that catches the drift and starts, proclaiming that the state is the cause of our problems here, and behind that is the lack of knowledge on the part of so many people. I think those are great signs for our future. And I'm not pessimistic. I am optimistic because I've seen things go so well for the good guys, and they're really falling apart for the bad guys in this world. And more Americans right now don't trust their government. I mean, the public opinion polling shows that 60% of all Americans don't trust any politician and think that they're up to no good. Only 10% think positively about politicians. And then there's, another 30% that are either neutral or slightly negative. So, things are going the right way, I think, in the sense that more people recognize that government is the systematic problem and that free markets really are the source of systematic success and progress. And really, indeed, the development of Western civilization didn't take place until markets started functioning and money start developing, and then later on banks and lending becoming viable institutions. So, this goes hand in hand historically so well that, they can't really hide that the way they would hope to.
Gotcha.
I would never have expected a Mises book to be the first book you would recommend, although you are at the Mises Institute, but
Well,
a little
yeah, I
work.
mean, we've got a lot of great books. We've got a lot of great economists. Um, I my work takes me to a guy named Richard Cantillon well before the Austrian school ever developed, and he's the guy who actually created economic theory about 300 years ago. He worked for John Law in the Mississippi Company, and in the aftermath, he came out a multimillionaire, one of the richest private individuals in the world, and he set out about writing uh, about how markets worked and about how governments failed and about when were markets well regulated and when were they distorted and what was the basis of interest rates and how national banks were a source of great concern. He really found he was the teacher of people like David Hume and Adam Smith and Thomas Jefferson. So,
Talk about having an impact. My God.
yeah, I mean, and also the British conservatives and the French liberals, Montesquieu, Lord Bolingbroke, just the physiocrats, just an amazing person. But of course, his book was censored. It had to be circulated in manuscript form anonymously. Um, and he was involved in politics later on, and he was murdered, or he faked his death and left the country during the excise crisis in London in 1735. But he left this phenomenal book where he created economics de novo, and it's very well recognized now that we know he was the writer, the circumstances under which he wrote it, and then also all the people who were influenced ultimately by his writings. So, I mean, it's a great pleasure and a great honor for me to do that. And I helped retranslate that manuscript, retitled an essay in economic theory. And you can actually Google the title and my name, PDF, and get a free downloadable copy of the book. But he overthrew the previously existing economic order, which were the mercantilists and the pre-Keynesians, and then he, like I said, he set us up with J.B. Say and Turgot and Adam Smith and David Hume and all the people that capitalism looks back at.
Fantastic. Well, we are about at that point. So I'd like to make the rounds here if I could. I think we answered most of the questions. I think a couple last few came in via the chat as opposed to the Q&A. We're not going to get to those. I apologize. But Dr. Thornton, if you could share with folks, the most important point you'd want them to take away from the past hour and a half with you. And once again, how they can reach you. Knowing full well, by the way, that tomorrow morning, everybody that registered, not just the attendees, is going to get a recap email with a link to the full video here tonight, as well as links to anything that, you're going to offer folks. So, Doctor, if you could.
Yeah, well, people in the economy are in peril right now, and there's also a lot of ignorance in the world today and a lot of confusion, and people are kind of desperate, and a lot of that boils down to an ignorance of how the world works, economically speaking, and also misconceptions about how politics works, not so much for the general public good, but in the interest of the politicians and the interest groups themselves. This is not a radical perspective in economics. This is a standard perspective in economics. But I think that people will feel better about their situation. They'll be able to better deal with their situation because they'll be better able to understand the economy at large if you show some effort and interest in learning more about the Austrian perspective of economics. If you're here because you have some interest in gold and silver and hard assets in general, then you're probably halfway home. You just need to invest some time, subscribe to some of our newsletters and podcasts, not take a deep dive all at once into this, but gradually learn yourself into a position of strength and knowledge of how markets work and why governments always fail. Your life is going to get a lot better.
Fantastic. Adrian?
Yeah, just briefly, a couple of points that you made. One on the financial side, getting out of debt and always having a cash reserve. I think that is absolutely critical. But I think the other big lesson from tonight is to educate yourself. And if I may, you may disagree, I don't know, but if I may, the book that really got me started was Henry Hazlitt, Economics in One Lesson. It is so simple. It is so easy to understand. You don't have to be an economist to read that book and learn the lessons. And from there, it was a deep dive into everything. But learning and educating, I think is educating yourself and your family, I think is critical.
Yeah, Hazlitt's book is for sale on our website in our online bookstore. Last year we gave away 100,000 copies, free copies to people around the United States, and we're trying to extend those kind of programs so that people can get free copies of introductory but very substantial books, hard books, um, based on Austrian economics.
Right.
Yeah, fantastic. My takeaway point, it's gotten a lot of press here recently. The central bank reserves exceeding, as you mentioned earlier, Dr. Thornton, U.S. Treasuries, and it's not the first time it's happened. It's the first time it's happened in a long time, and I think the central banks understand the importance of holding gold in their reserves at this point in time in our lives. And I absolutely think y'all should be paying attention to what they're doing and mimicking that and having your own gold standard. As always, we have some sort of offer to help you do that. Orders $5,000 or more, we'll give free shipping. We want you to get involved. That's basically a gold coin, for God's sakes. So take advantage of it. We want you to have that protection. I also want to mention that I say it every time. If you're looking for some asset management help internationally, resource stocks, et cetera, Adrian is absolutely amazing at what he does. I don't know if I could say that, but he is, so be it. And I will say that the fabulous work that they do at Mises doesn't come for free. It comes with a price, and to get that good information to educate people, they work on your generosity. So I highly encourage everybody listening here tonight to go ahead and make a donation to an incredible cause. Like you said earlier, some of the best money you could probably spend would be at the Mises Institute. And I agree if it helps people understand what's going on around us and helps us all be more successful. So, one last thing, Adrian, you want to make an announcement about who we're going to see on our next
Yeah,
episode
and
on the 29th of July?
July 29th, which is also Wednesday, make a note in your diary, and that's Stephanie Pomboy. If you know Stephanie, you know that we are in for an incredibly lively and amusing session. But
Yeah, she's very sharp.
oh, her. Yeah, she's very sharp. She knows the U.S. economy inside out. It'll be a good session.
Yeah, macromaven.com. And last thing I'll say is thanks to everybody here. It's we're going to celebrate our 250th anniversary as a country. Sorry, Adrian, before we meet again. But I wish everybody a wonderful 4th of July and happy birthday. And we still love our friends over in England, and happy for your win today against Croatia. I'm watching the World Cup very religiously. So. That's all I've got. Everybody have a wonderful evening, and I appreciate you joining us.
Thank you, everyone, and thank you, Dr. Thornton.
Thank you, Dr.
Enjoyed it. Thank you.
Bye-bye.